Bitcoin ripped past $82,000 on Tuesday. Shorts got absolutely liquidated. The Senate just scheduled a Clarity Act vote for next week, the White House wants the bill signed by July 4th, and strategists quietly made a $300 trillion bet that nobody is talking about.
All in 24 hours. Today we're walking through what's actually happening, what's structural, what's just noise, and how to think about it all without losing your mind. Hey, welcome back to czverse. I'm Maya.
And I'm Marcus. We don't dumb it down, we don't hype it up, and we definitely do not give financial advice. We just teach. Today we're focusing entirely on Bitcoin and market structure, because there is this massive confluence of news right now that adds up to something genuinely structural. So let's start with the price action that's grabbing all the headlines, right? Because the numbers kind of dictate the story here. Bitcoin opened May 8th around 80 grand, and throughout the day, it just ripped right past $82,000. We saw massive liquidations on the short side.
Yeah, sitting right in that 80 to 82 range by the weekend. I mean, that is up 19% over just the past month. But look, the price itself is really just a symptom. We need to look under the hood at what's actually driving this.
And honestly, that leads us to this jaw-dropping number, $300 trillion. This is the sheer scale of Strategy's quiet, monumental bet on global credit.
Exactly. We're going to unpack exactly how traditional fixed income money is literally entering crypto right now. But first, we really need to understand the immediate catalysts that pushed us into the 80s this week.
Section 1. The price picture. Decoupling from the noise.
Right, so we had a massive jobs report and some de-escalation in the Middle East, which kind of cleared out the immediate macro overhang. But structurally, ETF flows are absolutely the dominant force right now. This isn't retail, it isn't leverage speculation, it is pure institutional buying. Spot on. Every single dollar flowing into a spot Bitcoin ETF requires the issuer to actually buy and hold real Bitcoin. That literally removes supply from the available float. So, less float means there's less available to buy, which naturally pushes the price up as demand persists, which then attracts even more inflows. It's a classic flywheel effect. Okay, so if this flywheel is spinning so fast, why the resistance around 80 to 82K? Like, why aren't we just shooting straight up to 100? Well, it's because of what we call an electric fence in the options market. There's this massive wall of call options sitting right at the $80,000 strike price. So the options dealers who buy those contracts, they actually have to hedge their exposure by selling Bitcoin as the price climbs. It creates this temporary braking mechanism. Every time we push above 80K, dealer hedging essentially pulls it back down.
Section 2. The Clarity Act, Compromise, Unblocking Capital.
So the Clarity Act passed the House back in 2025, but it totally stalled out in the Senate. Traditional banks had been absolutely terrified of stablecoins paying yield because they thought it would basically gut their traditional savings accounts.
Right. And so the compromise here is actually pretty elegant. Yield on reserves is banned, meaning you can't just park money in USDC and passively earn 4%. But activity-based rewards are allowed. If you actually use the stablecoin in transactions, issuers can give you cashback or points. It protects the traditional banks, but it doesn't kill the crypto use case.
And here is the exact political timeline you need to watch. The Senate Banking Committee holds the markup vote on May 14th. From there, the target is the Senate floor in June or July, with the White House aiming for a July 4th signing.
And this is huge. Legislative prediction markets are currently pricing the bill's passage at about 70%. That's a highly meaningful signal. Industry heavyweights like Coinbase, Circle, and Strategy are all out there publicly backing this exact compromise.
Section 3. The Macro Backdrop, Mixed Signals.
So we have sticky 4% inflation and an economy running hot enough to mean less rate cutting from the Fed. Which brings up the obvious question, right? Why is Bitcoin surging right now when a tight dollar traditionally crushes risk assets? It's because right now, Bitcoin's idiosyncratic catalysts, like those ETF flows we talked about, and this massive legislative momentum, they are completely overpowering traditional macro headwinds. The macro picture is just one input, and the crypto-specific tailwinds are currently doing the heavier lifting.
Section 4. The ETF Flood and Strategies Bet.
With over $630 million pouring into spot ETFs in a single day recently, look at STRC. This is Strategy's Bitcoin-backed preferred stock. It just hit an $8.5 billion market cap, basically from zero in just 9 months.
And this right here is how traditional fixed income money is quietly entering crypto. BlackRock's IPRF preferred equity ETF just took a $210 million position in STRC. UBS just added $1.12 billion of Strategy's standard stock. We are seeing real institutional fixed income money finding its way to Bitcoin via this credit wrapper.
And to really understand why that matters, consider the sheer scale. The entire spot Bitcoin market is roughly $2 trillion. The global fixed income market, that's $130 trillion.
Exactly. If even a fraction of a percent of that 130 trillion allocates to Bitcoin-backed credit instruments, the demand impact on the underlying asset is just structural and it is enormous.
Which brings us back to the core thesis, anchored by Strategy's chairman last week. Just read this quote. The world's $300 trillion credit market is a much bigger opportunity than the world's roughly $2 trillion Bitcoin market.
Basically, he's saying the end game isn't just Bitcoin going up in price. The actual end game is Bitcoin becoming the base layer collateral for a completely new generation of global credit, and that reshapes traditional finance entirely.
Section 5. The RWA Tokenization Wave. Digital twins.
We are seeing traditional assets literally becoming digital twins on-chain. BlackRock's tokenized money market fund, BUIDL, just crossed $1 billion. Total on-chain U.S. Treasuries on Ethereum just hit $8 billion. And because Ethereum is currently the dominant settlement chain for this explosion, we are seeing some massive price targets. Fundstrat's Tom Lee actually just set a $22,000 target for ETH.
Yeah, and he cites the real-world asset tokenization thesis directly. As more of traditional finance tokenizes and settles on Ethereum, the chain's monetary premium just grows exponentially.
Section 6. The risks nobody's pricing in. What breaks? Okay, so that's the bull case. It's loud, it's very compelling. But let's sharply pivot away from all the hype for a second. What actually breaks this entire setup? Let's look at the risk matrix. Risk 1. The Clarity Act fails. Polymarket says there's a 70% chance of passage, which means there is a very real 30% chance of failure. If the bank lobby kills it, that legislative tailwind vanishes and Bitcoin likely drops straight back into the 70s. Risk 2. A hawkish Fed reversal if inflation doesn't cool down. Risk 3, stablecoin concentration. If USDC or Tether faces a regulatory or banking crisis and depegs, the shock to institutional crypto would be severe. And risk 4, Coinbase custody holds the keys for most of these massive spot ETFs. A critical security event there would be totally devastating.
And there is also a serious, looming technological threat. China just announced the Hanyuan 2, which is a 200-qubit neutral atom quantum computer. The fear here is that quantum computing eventually breaks Bitcoin's elliptic curve cryptography entirely.
We do need to ground this in reality, though. To actually break Bitcoin, you'd need thousands of stable, logical qubits running highly specific algorithms. We are definitely not there yet. The trajectory is real, and the industry absolutely needs to migrate to quantum-resistant signatures, but it's a future risk, not an immediate one. Let's rapid-fire some peripheral structural signals. Half of Ivy League endowments are reportedly considering crypto allocations. That is a multi-trillion-dollar pool of long-duration capital. Emerging markets are heavily driving stablecoin adoption for dollar exposure. But on the flip side, balancing out that promise, DL News reported that April saw the highest number of crypto hacks ever. Bridges, protocols, stolen funds. The infrastructure is definitely scaling, but it is still visibly maturing.
Which brings us to market sentiment, currently sitting at 47 on the Fear and Greed Index. Dead neutral.
Right, so it's not euphoric, and it's not in capitulation. It's a wait-and-see posture. And historically speaking, this exact neutral consolidation phase is where smart, institutional accumulation quietly occurs.
Section 7, the 2026 forecast, the 90-day window. You have the ETF flywheel eating up supply, the RWA tokenization wave bringing traditional assets on chain, and a legislative compromise with a 70% chance of clearing the regulatory fog. Look, this isn't just a price pump. It's a fundamental structural shift in how traditional capital interacts with digital collateral.
So the ultimate question we want to pose to you, looking at all these structural shifts, what is your highest conviction that in this 90-day window? Are you bullish on the Clarity Act? Are you looking at infrastructure? Or are you just waiting out the macro risks?
Drop it in the comments. We genuinely read every single one. The immediate catalyst is that May 14th Senate markup vote. Watch that closely. Watch the ETF flows. The data will tell the story. This has been Cryptoverse. We'll see you in the next one.